Michael, great to see you. 1% expansion. This is a revision from actually an 0.8% contraction. I mean, how did they get it so wrong?
Well, it's easy to get it wrong in financial markets, and don't forget this business teaches us humility. But I suppose the real question is not just about Japan. I think the Japanese numbers are surprising to the upside. I think the bigger question is, what if US numbers would surprise to the upside, and what if the Fed would be behind the curve? And I think this is why Japan is an interesting example of what we potentially could see from the Fed, that the Fed will raise their interest rates and maybe is already behind the curve, and hence a lot of people potentially could get it wrong in the sense of being too sanguine about the potential Fed rate hike increase.
Well, Michael, why did you say that, really, at the end of the day? Because, OK, sure, the data has been pointing upwards, but is there something that you've seen that has set off alarm bells?
No, I mean, I think the biggest alarm bell, in my personal opinion, is that many people are sort of trading the market on further, ever more belief that there's more stimulus. I mean, I think Draghi and the disappointment the other day pointed out that it's not always that case. That I suppose it should not always be about quantitative easing. It should be about fundamentally driven investments. And here, maybe fundamentally speaking, a lot of people are potentially underestimating the potential dislocation we could see when rates finally go up. And I think the Fed has done a great job in trying to prepare the market, but the acid test will come once interest rates in America go up, and how much pressure it potentially could put on corporate bond spreads, and also to a lesser extent on emerging market currencies and bonds, and also emerging market equities.
Isn't this all baked into the price at the moment?
Yeah, well, that's the question. I mean, maybe not. And I mean, look at the emerging markets. They're cheap. I mean, they're maybe cheap for a reason, but valuation in emerging market is very cheap, but they still seem to be going lower. I mean, oil yesterday again came down massively and sharply. Maybe it's not all priced in yet, right? And I think this is the whole dilemma, that to some extent we need higher rates in the US, where in the world maybe you still need more accommodative monetary policy. So this divergence playing out into 2016 most probably could lead to more volatility. And hence, yes, to answer your question, most probably no, not everything is priced in yet.
OK, you know, as you manage this money and you strategize for the family office here, so what are you looking at next year, 2016? The volatility likely probably to continue, given what you just said about the divergence in the global economy. So tell us what your thoughts are here.
I mean, we are trying to reduce risk. We're also using that recent rebound as an opportunity to buy insurance, and also to diversify portfolios away from just being long directional into more long short strategies. And I think basically the real risk could be that the bond markets could be maybe mispricing liquidity. I think this is the biggest risk. I mean, if rates finally go up, we might see some pressure in the fixed income markets, especially in yields and in spreads. Because if you remember the August correction, many corporate bonds actually traded like equities, and there's a possibility that we could see this again in 2016.
No. You know, people are always talking about how we're seeing the Chinese economy evolve from this old economy to the new economy, more service-orientated. But the thing is about that old economy bit, it's a massive headache, isn't it? I mean, we've got at the moment, you know, excess, a lot of debt here, excess capacity. These are issues which aren't really being addressed properly. Would you not agree?
Yeah, I would agree with that. And don't forget, it's also a question of size. I mean, even though the new economy is very attractive in China, it's actually, relatively speaking, small given the size of the overall economy. And I think this is part of the dilemma. And I think what's interesting to note is that in China, many people are voting with their own money and their own feet. I mean, capital flight out of China is very high. And I think the stock market correction, or mini crash, if you will, and the authorities' handling of that to some extent actually caused more damage than it did good, in the sense that many people are now afraid to invest in China, especially local Chinese investors. And I suppose the bigger question is, going forward, what could be the impact on the Chinese fixed income markets once rates in America go up? And I think that is what still maybe is not really fully priced in yet. And I think we could see some dislocation in Chinese fixed income markets going into next year.
Michael, great talking to you as ever. Michael Preiss there from Taurus Family Office.